Thank you, Carl. So, as Barb said, we are now going to enter into this popcorn session. And Barb set it up very nicely. This is to address that question that you had about what kind of strategies and options were out there. And so we want to just give you, a small sampling from some different asset classes, some different strategies of some of the types of things that are out there. As Barb said, we're going to move through this very quickly and diligently pull our speakers at 4 minutes. And so we'll get off to the tour and reception on time. Now, the one speaker that I have not been able to connect with is Matt Breidert from Ecofin. Matt, are you here? Come on up.
Well, rather than try to do a 4-minute pitch of a fund, which is pretty complicated, I'm just going to try to whet your appetite a little bit on a little part of the ESG universe that surely you know about, but maybe we can think about somewhat differently. So one of the areas that we focus on as managers is around renewable infrastructure. And I think a lot of people think about the solar and wind industries that it's a cottage or a niche industry. It's policy driven. I'm going to use John's quote. It was perfect. It sort of sits in this area where people pretend it isn't investing. It's this thing that subsidizes, not real. I want to just give you an idea of what we think the forecast looks like, and this is from Bloomberg and our own internal projections based on going company by company around the world, what they expect to install over the next 15 to 20 years. These are absolutely enormous numbers. And it's no longer a cottage industry. It's larger than the entire rest of the fossil industry. And this is on the power generation side. Now, what's been driving the first part of that, of course, were subsidies. The second part is all about cost and improvement. These two visuals here, the one on the left is the trajectory over the last 5 years or 10 years of improvement in cost per unit of output. The efficiency gains in renewable infrastructure are simply staggering. And they're really starting to happen now on the battery side. And the important note here is that as these costs come down, the ability to deploy more and more capital increases, and the likelihood of interruption or disruption of traditional incumbents in these industries is growing. So I think with this slide, this will be my last slide, I want to lay out to you a case that what we're witnessing here is the birth of the first sub-investment class within ESG, and this is specifically around renewable infrastructure. The unique part of renewable infrastructure, of course, is that the input is perpetuity and it's free, which means that those cost reductions that you saw in the prior slide will manifest themselves at the end of the useful life of any project that you build today with an ability to recreate the project at potentially a much lower cost. And if we hold power prices constant in nominal terms, which most economists would already say is probably a bit aggressive, you should theoretically be able to improve the IRR at the end of the useful life of the infrastructure than at the beginning. If you think about the other major asset class, at least in the US, around energy infrastructure, it's master limited partnerships. Master limited partnerships, of course, exploit fossil resources that deplete, and at the end of their useful lives, that capital is effectively used up, and the fossil resource is no longer economic. And if anybody's been to Galveston, Texas, and you look out in the water, you can see lots of old rigs that don't have tops that are now scuba diving sites. We think effectively what's happening right now is a race. It started about 7 or 8 years ago, and it's going to continue for the next 10 to 15 years. The race is to get as many good projects put in the ground as you can, because they're going to be perpetuities of value. And we think that the real value of these projects could actually come 20, 40 years later, not what you're generating today. So if you think about this slide with this declining cost curve at a constant price, it actually is a REIT upside down. So if you think about REITs, you're effectively forming capital at a constant cost, and you're receiving increasing rents over time. We think this is actually going to be a very attractive inflation-adjusted asset class. And we're starting to see larger institutions, or larger institutional investors in some of the same meetings that we've been going to for the last 5 to 10 years, and they're a lot bigger and a lot more serious. So we think the capital is definitely going to continue to flow in. Policies will continue to be supportive of this area, and we think, look, there's even a hidden option value here. I said constant power price. Imagine if we really transition to electric cars. This is a fixed capital, no marginal cost industry. If we got even a 10% improvement in electricity prices, you could see, a 40 to 50% improvement in the levered equity return. So rather than pitch the fund, I just want to give you some fuel to go back to your institutions and say, hey, this area.
Good afternoon. I'm Tim Coffin with Breckinridge Capital Advisors, and we are a fixed income manager in Boston. We manage a little over $27 billion in assets, and we have fully integrated ESG into our entire investment process. We're a separate account manager. We don't manage any funds, so there is a lot of customization involved. But again, as Liz pointed out earlier, that's really what the customer, the client will bring to us. So the why we invest, why we have fully integrated ESG is we're a high-grade manager. So from our standpoint, traditional financial analysis, although it is still the bedrock of our fundamental credit research, we have 16 analysts, it tends to be somewhat backwards looking. And since our responsibility is to improve risk-adjusted returns by and holding preservation of capital and predictable, reliable cash flows to the highest standard, anything we can do that gives us a more forward-looking assessment of, or ideas of symptoms of kind of idiosyncratic risk, whether it's reputation risk or litigation risk, externalized costs. We want to be able to do that because we believe it'll help us improve risk-adjusted returns over the long term. So that's why we have integrated ESG. We've done it across our whole platform. Every analyst assigns an ESG rating to their credit as well as the credit ratings and risk ratings. You could have hired Breckinridge in 1997, never heard of ESG, and you're getting it because we think it's important to our process and adds rigor to our process. The how we do it is it really started off largely as a quantitative process in the corporate bond market. We were looking at external rating services. We subscribe to MSCI, Sustainalytics. We also look at a number of reputation ranking services. So do companies report to the Carbon Disclosure Project? Are they signatories to the UN Global Compact, Newsweek Green Rankings? All of those things which individually don't have a big impact, but when you aggregate them together, looks like they give us a sense of reputation risk. We're also one of the larger buyers of municipal bonds in the market, and we've developed proprietary ESG frameworks for municipal bonds. We have ratings on about 4,000 municipal bonds, including higher ed. So we look at kind of extra financials in that factor. And then finally, I would say that as the process has evolved at Breckinridge, it's become more qualitative. And a big part of that is we've actually started engaging. Back in 2013, we started engaging with our largest holdings. And that's given us, I've heard a lot of comments from Tim today and Jack that a lot of the companies we invest in have great sustainability stories to tell. There is an impact story to the way they're incrementally changing their businesses to operate in a new ecosystem, and we want to measure the materiality of those changes. And so being able to engage with these companies, measure that from kind of a materiality of incremental impact, all of that is important. So ultimately, we're doing this to improve risk-adjusted returns. We think it adds risk, helps mitigate risk in our portfolios and adds to the predictability and the reliability of the cash flows. And ultimately, we're being hired to be a counterbalance to risk in our portfolios. So if this information is out there, we're really obliged to manage it and to research it. Fair enough?
So I have, hopefully going to share 3 things. Boston Common's investment beliefs around sustainability, our engagement. I'm going to give a case study very quickly on our engagement with global financial institutions on climate change. And if I have time, I'll leave some actions that investors can take that may act. So what do we believe? We have a long-term view. We believe a long-term view is necessary to generate sustainable returns. And we believe the path to long-term outperformance goes through environmental, social, and governance analysis. So to John's point, we are investors, and we have beliefs around sustainability as part of our investment thesis. But we're first and foremost investment managers. Every strategy that we offer integrates environmental, social, and governance criteria alongside financial criteria, from the definition of the investable universe to portfolio selection. Ultimately, we think that using this information is going to help us identify managements which are longer term in their orientation and thinking, and eventually become reflected in the value of the shares. So that's kind of how we think about it. As active investors, there are a number of tools that are available to us. So we heard about a lot of them earlier. We vote our proxies, we support, file and co-file shareholder resolutions, we engage in dialogue on sustainability issues with the companies in our portfolio, we collaborate with other investors on investor statements and letters, And we actually engage in public policy as well. We submit commentary to federal, state, creditors, all those things. But I'm going to focus on the engagement that we did on carbon risk in the finance sector. So what did we do? We began a multi-year engagement project focused on climate risk in 2014. We published a thought piece in 2014 which called on the banking industry to answer a series of questions on risk management, climate change strategy, and identification of opportunities associated with climate change. And then we worked to assemble a global coalition which ultimately resulted in having 80 investors around the world managing over $500 billion in assets as part of this initiative. Our investor group had intense dialogue with 22 financial institutions globally, and we published the findings from our research in a report, Are Banks Prepared for Climate Change? The short answer is not so much. Please come see me if you'd like a copy. So why did we do this? For a couple of reasons. We want to help build more sustainable financial markets. And banks and financial institutions are absolutely essential to creating economic value and shared prosperity for the globe. It's a massive challenge. Also, we're a large cap diversified manager, so we cannot avoid investing in financial institutions. They're a big chunk of our investable universe. So we want to ensure that they're actually the best of, you don't want to just get the best of a bad lot of potential investments. We also think all investors have an interest in encouraging the entire sector to be more sustainable. So there are the key questions. I think they're probably too detailed for me to go through, but I'm happy to talk to anyone who's interested to learn more. We will be publishing a follow-up to this research in 2017, so results of the engagements that we've undertaken this year and examples of best practice amongst financial institutions. And then I just wanted to finish off on what can you do. A few things. For those of you who do have separately managed accounts, we've talked about these already, sponsor shareholder resolutions focus on climate disclosure and sustainability during CDP. Formerly the Carbon Disclosure Project as a supporting signatory. Ask your investment managers to do portfolio level carbon analysis. We've done one, it wasn't that painful. And invest in lower carbon strategies. Thanks.
Well, great to be here with all of you. I'm Ian Monroe, and one hat is I'm a quantitative sustainability and climate solution geek teaching courses on the subject at Stanford University. But the hat that I'm here to talk to you guys about right now is EcoCapital, which I also co-founded, which focuses on creating indexes and index and active investment products that optimize for sustainability and financial performance at the same time. And our core thesis, like has been shared on other panels, is really if you get more accurate sustainability data, particularly as it relates to supply chain sustainability and efficiency, it's also helping you identify which companies have better managers and helping you find outperformance in essentially every industry that we've looked at. And so our smart sustainability process that we use for creating indexes and investment funds is a combination of this deeper dive, what we think is more accurate sustainability data, with what we think is also a better construction process. And an example in the real world of how this works is we go beyond the self-reported CSR data that unfortunately still underpins a lot of the ESG data sets that are out there. As you would probably guess, even though it's getting increasingly mainstream to self-report around sustainability, companies generally are still putting out CSR reports from their marketing departments, and they're incentivized to say good things about themselves. We try to cut through the greenwashing to figure out how efficient and sustainable a company's supply chain really is. So we've been able to see in the 10 years of data that we've looked at that Volkswagen, for example, has been one of the least sustainable and efficient automakers for the last 10 years, even though it's been getting very high ESG ratings up until the emissions scandal broke. Tesla, on the other hand, like many smaller companies, has actually been getting Fs in sustainability ratings for many of the leading sustainability ESG rating systems, simply because they don't put out CSR reports saying how great they are. Again, when we dive deeper, we see that they actually are outperforming the auto industry as one of the most efficient and sustainable companies. But the quantitative data is not enough. You want to also add in a qualitative screening element. So we start with this quantitative efficiency and sustainability analysis to find the leaders in each industry. Then we do add in the more qualitative SRI screens to take out fossil fuels, to take out tobacco, to take out private prisons and weapons. And we're even now opening up this process to sustainability experts throughout academia. So we actually can give your students and your faculty a direct voice in the screening process to customize a solution that's really right for you. And the good news is, it's working. With 10 years of back testing, we've outperformed with this technique essentially every market benchmark, like S&P 500 that you want to compare it to. And with the year of live performance that we have now with the Etho ETF that's traded on the New York Stock Exchange, we've outperformed S&P 500 and essentially every major market benchmark, while quantitatively reducing greenhouse gas emissions far below the benchmark targets. So with that, we think we have something that really is different and better and applies systematic ESG SRI screens to not only take out the bad actors, but actually highlight who are the true leaders in each industry. And I'd love to talk with more of you, and all of you, if possible, about how to get engaged in the process.
Good afternoon. Thanks, George. So I'm here to talk about how this works in emerging and frontier markets. Caravel Management is a firm that's been investing in EM and frontier for the past 12 years. And I think what we've identified during that period is that these markets are among the most impacted by ESG factors, right? You've got countries that are the most vulnerable to climate change, that have terrible pollution issues. You've got issues with community relations. You've got resource scarcity. You've got corruption. You've got accounting issues. You've got weak institutions. All of the things that that impact a company's ability to perform and grow in these markets. A lot of these factors are sustainability related, and so we've decided that the companies that are best positioned to grow and thrive in EM and frontier are those that do adhere to high sustainability criteria. I think we think about this in terms of 4 factors. So we take a somewhat ethically or morally agnostic approach. We're really looking for companies where, because of their sustainability profile, they can grow faster than their peers, they can achieve higher profitability, they can reduce their cost of capital, and they can mitigate risk. And we think that as important as this is in developed markets, it's that much more important in EM. We think it allows you to identify really high quality companies and also to hold on to those companies through moments of volatility so that you have something to hold on to that's beyond just a PE multiple or an EV/EBITDA multiple. So how do we do this? I wish I could say that we relied on external data providers that would make my life a lot easier, but that doesn't really work in our markets. You have to do it yourself. It's a lot of heavy lifting. And as you know, in these markets, data and disclosure is relatively poor. So a lot of it is about having conversations with management teams. It's about working with NGOs. It's about talking to suppliers and customers and regulators. It's about using the internet. Social media has become an important source of information, whether it's Glassdoor or Indeed, to understand sort of how employees feel about the company, but also Facebook and Instagram can be good sources of information as well. And again, what we're trying to do is identify these factors and then draw straight lines, direct lines between our conclusions on those matters and the economic performance of the company. So that's what we think makes the difference. We think it helps you make better investment decisions. The other aspect that I think is important and has been touched upon by other people is the area of engagement. Proxy voting is important in developed markets. It's less important in our markets. We do vote proxies, but our experience is that in many companies where you have a majority ownership, whether it's a government or a family or another sponsor or institution, sometimes those are not the most effective ways to get things done. It's really about engaging with the company. And you can be a small investor or a large investor if you're able to make your case and demonstrate to them why it is that it's in their interest to do things differently. That can be very powerful. A couple things I'll just mention at the end, some sort of food for thought. The first is, I really encourage all of you to consider increasing your allocation to EM and frontier. Not because that's where we invest, but really because that is the future of growth in this world. And there are some amazing opportunities out there. We find that U.S. investors especially are underallocated to that sector. The second is, and I think Ian talked about this before, really you have to be smart about the information that's out there. There's a lot of data, but not a lot of it is informative in terms of making good investment decisions. And then the third is really think about companies that are at an inflection point. It may not be finding the best company that has the highest ratings. It's the company that you think can improve the most, because that's where alpha is generated. Thank you.
I'm Adam Strauss. I'm CEO of Peak & Singer Strauss Asset Management. We're a Chicago-based investment manager just down the street from here. We've been in the business for a little over 25 years managing money. Over the last 10 years, we've been managing Appleseed Fund, which is a go anywhere value ESG strategy. And over the last 2 years, we've been managing a alternative ESG long-short strategy. So our general approach with investing is, first of all, go anywhere value. So we're investing across the market cap spectrum, across geographies, and in many cases, across asset classes. We use ESG as a research tool to help us find outstanding investments that will help us as managers outperform our benchmarks over the long run. Recently, we decided to go fossil-free, so all of Appleseed's strategies are fossil-free now. And we try to make a difference with shareholder advocacy. Take a few companies out of our portfolio every year where we try to really make a substantial difference in our governance and the way that they approach the business. In terms of our investment approach, we seek out uncorrelated returns for our investors, and we are very, very active. We're probably in the top 1% of our peers in terms of active shares. So, I guess the previous speaker encouraged investment in frontier markets. We encourage investment towards active managers. That's our view of the world. And then I guess finally, our portfolio managers put skin in the game with our investment strategies. All of our Appleseed strategies, we're heavily invested in ourselves. So for us, ESG is a source of alpha. On the long side, we see it as an opportunity to identify companies that are going to grow faster than GDP over the next couple of decades because they're involved in certain sustainable related industries like natural food or alternative energy. We also use the ESG research that we've done to identify management teams and boards that are high quality and that are going to be much more long-term in their orientation towards creating enduring value for shareholders. And then on the defensive side, we also use it as a risk mitigation tool. We're risk averse and we want to do whatever we can to avoid blowups, and we think that ESG is a really useful method of identifying companies with significant off-balance sheet liabilities, such as environmental liability or legal liability. I mentioned earlier that we seek out uncorrelated returns. So just to share a little bit more on that topic with regard to some of the work that we've done with our alternative long-short strategy. We recently published a white paper about trying to identify alpha on the short side by trying to find companies that have particularly bad environmental, social, and governance performance, where they are destroying value through that underperformance. And we sort of look at our universe as, we categorize these companies as unsustainable, unethical, and unsafe. And in this long-short strategy, we're trying to make money for investors, not just by finding good companies on the long side, but trying to make money for our investors by finding bad companies on the short side. The white papers are out on the table, so if anybody wants to take a look, there's a pile of them, and if the pile runs out, be happy to contact me later. We can provide it for you. Thanks very much.